Hello, everybody. This is Wednesday, August 14th. Welcome to midway through August. This is your weekly market insights, Northbound Wealth Management Podcast. Stocks stage comeback after heavy Monday. That was last week's headline. I put this out on the blog a couple days ago. Stocks ended last week with modest losses, masking a volatile 5-day trading period that saw investors embrace recession concerns and then dismiss the slowdown talk as speculation as the week progressed. The Dow Jones Industrial Average slipped 0.60%, while the S&P 500 ended flat at negative 0.04%. The NASDAQ Composite dipped 0.18%. MSCI EAFE Index, which tracks developed overseas stock markets, fell 1.21%. Stocks stage a comeback. Monday was the worst day for the S&P 500 and the Dow in nearly 2 years. As recession talk grew louder, investors took risk-off position. On Monday, the Japanese market had its worst drop since 1987 as markets participants unwound positions from popular trading strategy called the carry trade amid a global sell-off in stock prices. But Thursday, initial jobless claims fell less than expected, a positive sign for the labor markets, which quieted some of the recession talk. Also, as the week progressed, there was growing speculation that the July jobs report was more of an outlier than a lead indicator of a pending recession. By Friday's close, all three major averages had regained most of the week's losses. And actually, that momentum has carried in the last couple of days as well. So, good news. The bull market's intact. And we had a correction. On my website, I've got Y charts, weekly market insights, major index return summary. Dow Jones Industrial Average for the year is up 5.78%. MSCI EAFE is up 3.55%. NASDAQ Composite is up 11.43%. And S&P 500 is up 12.42% year to date. Still doing very, very well for a year in the stock market. There was also a big spike in volatility. The VIX last Monday hit 68, which is one of the highest readings ever on record, in the top grouping of that, actually. And that was actually a day that would be good to be buying. And so that was a trigger to buy. And for me, at least to some degree, given all the confluence of factors that I considered and indicators, and I usually don't go wrong in doing that. And so far, that trade has worked out real well. Happy about it for clients in their portfolios. So if you're a client of mine, you may have seen some activity during that period of time last week. 10-year note review. So let's take a look at the 10-year Treasury yield. It is actually at 3.94%. That is substantially lower than the 4.45% we saw just 3 months ago. Higher also than the year ago number of 4%. So, 1 month ago, the 10-year was at 4.3. So we've had quite the drop in interest rates. Thank you, Y charts. August 10th data. I'll update it next week as well as I go through the weekly market insights. Let's take a look at mortgages. Last Thursday, the average rate on a 30-year fixed mortgage dropped to 6.47%, a 15-month low. Many home buyers welcomed the news, and it appeared to help support Thursday's rally, but the announcement left some wondering whether rates would continue to trend lower. Mortgage rates are tied to the interest rate set by the Federal Reserve. Some speculated the drop was due to market participants anticipating the Fed would adjust rates in September, which remains anything but certain. All right, this week, key economic data. Tuesday, PPI, which happened yesterday. And then the Fed official Raphael Bostic speaks. Wednesday, Consumer Price Index, which should be today. EEI Petroleum Status Report Wednesday as well. Thursday, jobless claims, retail sales, industrial production, business inventories, Fed officials. There's a couple of them. Fed heads talking, who cares? Friday, housing starts and permits, consumer sentiment, Fed official Austin Goolsbee speaks. It seems like the focus is on all these Fed officials speaking. And frankly, the only one that really matters is Jerome Powell. He's the one that moves markets. And I'm a bit disappointed in the Fed. They should have lowered rates. I talked about it last week on the podcast. They didn't. They're going to wait till their September session to decide that. And right before the election, it'll be very, very politicized and very interesting. I know they're waiting for inflation data to come in lighter than expected. We'll get another report on that here soon. But it looks like inflation's trending down and rates are staying high. It's locked up the housing market. A lot of people, like Home Depot, reported, and their CFO basically was saying, well, it seems like people are deferring their bigger projects, bigger purchases until the Fed lowers rates. So that's actually really good news, because that probably means the Fed is going to lower rates, and the market's pricing that in, as well as that doesn't mean we're going to head into a recession if the consumer is healthy, strong, and spending, especially at the higher end. And I know it's a bifurcated market. There are a lot of people feeling the pain of inflation, and it's still there, especially the middle to lower class. The wealthy folks in the middle to upper class don't really feel it as much because they have abundant resources to be able to not feel it. Looking through an investor's lens or an investment lens, it's good when the consumer is doing just fine. I know that consumer debt and credit card debt has gone up a lot and has hit very high levels. So this consumer is slowing down, and that is something to be looking at. But it's not like meaning there's an imminent recession with that. And then the SOM rule being triggered, which is not exactly the best or most accurate indicator. But obviously, when you look at employment, if you see a bunch of companies announcing layoffs, especially the corporate America, the bigger ones that we actually have a read through to see the data, you're going to see that impact the unemployment rate. And if people are being laid off, that means they're going to start pulling back. Sometimes you'll get these anomalies where you'll get a pickup. Sometimes, not very often. Historically, the trend is once the unemployment rate starts going, it doesn't stop. It kind of keeps going. But in this case, right before the holiday season, and with how interest rates are, and all the other confluence of factors, not just those few things, but it looks like you're going to get a spike up or a bump up in unemployment. But then those folks are later on would likely be rehired. I heard a podcast earlier today, and I liked what somebody was saying about it. I forget exactly who it was, but they were talking about how if job layoffs happen at the higher end, like white collar jobs, that would have a more of an impact on the consumer and spending than would be other areas of the economy on the lower end, blue collar workers. So very interesting perspective there. I thought that makes sense to me. All right. Notable companies reporting earnings. Like I said, Tuesday was Home Depot. Wednesday, which today Cisco reports. Thursday, which is tomorrow, Walmart, Applied Materials, and Deere. And so, I follow an economic calendar, and I also listen to conference calls in and around the reports that come out every quarter on quite a few companies. So tracking that, looking at charts as well. Tax tip of the week. So divorce or separation can affect your taxes. So the first thing to consider is alimony payments. Alimony payments paid under a divorce or separation instrument are deductible by the payer, and the recipient must include it in income. Alimony is not subject to tax withholding, so increasing the tax paid during the year may be necessary to avoid a penalty. The next thing to consider is IRA contributions. A divorce agreement by the end of the year means that taxpayers can't deduct contributions made to a former spouse's traditional IRA. They can only deduct contributions made to their own traditional IRA. Once you reach the age of 73, you must begin taking RMDs from a traditional IRA in most circumstances. Withdrawals from traditional IRAs are taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to a 10% federal income tax penalty. And again, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. All right, stay tuned for the next segment. We got a good show for you today. Thanks. Hello, everyone. I just want to talk about the inflation print that just released this morning, moments ago. And I'm listening to a bunch of economists debate it on Bloomberg. It's very interesting. But the U.S. July consumer prices rose 0.2% month over month, which was in line with estimates of 0.2%. The same U.S. July core CPI rises 3.2% year over year. Estimate was 3.2%. So it was in line with that. What that means is that inflation since 2022 has been trending down because the rise in interest rates by the Fed has been combating that as a force against rising consumer prices. So now we're seeing that trend. That trend has been coming down, and it's headed towards the Fed's 2% inflation target. And it's actually quite good news. That means that the Fed's likely to lower rates in September. And if you parse out the components of inflation, and services is hanging in there and staying up, while goods inflation is deflationary across the globe. And so what I've been listening to and thinking about is, if the Fed lowers interest rates, that's going to be very helpful to the consumer, for one, especially the middle class and small businesses across America, which is a powerful force, right? But then also, if you look at currencies, and if we get deflation in the currency of the US dollar, that's actually going to help in global sales of goods for the economy overall, whether it's global or domestic here in the United States. And so that's actually going to be a good thing, and a catalyst for more broadening out of the market activity that's going on in market analysis that I do in charting, looking at like 38% of the S&P 500 stock components are trading above the S&P 500 as far as growth year to date. That is actually a reversal and a very good sign, because last year in 2023, the story was there's only like 7 stocks that actually were holding up the index in a bull market. Everything else wasn't doing well, and that has reversed this year. So, and we're seeing that data carry and follow through, and I'm really excited about that. Because that means that we likely could get a sustained bull market that is through kind of a corrective period. Now, we got to watch that. Nobody has a crystal ball, so I'll be tracking and watching that. But the inflation seems to be coming down, so we should see that happen at the stores. All of us that work hard or are in retirement having to go shopping and buy groceries and things like that, we ought to see those prices start to come down over time. I really don't like personally how insurance prices have been jacked up, and that's kind of a silent killer in there, So hopefully we can see insurance companies have to adjust and come back down on their inflation costs on insurance. All right, moving ahead, stay tuned for the next segment. Here's another observance you might have missed. This week is National Simplify Your Life Week. Who knew? It made me think about organizing and cleaning out some of our closets, and maybe even tackling the garage. Who doesn't love a clean garage? But more importantly, it's also a good reminder that your finances can become cluttered and unorganized just as easily as your home. Here are a few simple steps that you can take to simplify your financial life. Review your budget. Take a close look at your income and expenses, see where your money is going, and identify areas you can cut back. Consolidate your accounts. Combining multiple accounts or credit cards can make tracking your expenses and managing your money easier. Automate your finances, which is consider setting up automatic bill payments and savings transfers to help take the guesswork out of monthly finances. Declutter your wallet. Get rid of old receipts, unused gift cards, and expired coupons to create a more organized and streamlined wallet. If you're looking for guidance on consolidating or organizing your finances, we can offer a few tips here at Northbound Wealth Management. So check this out. Watching my children grow up is one of the greatest joys in life and a source of so much pride and maybe a little stress too. I want nothing more than to see them succeed in life and be prepared for life's challenges. As a financial professional, I'm passionate about helping families empower their children for a bright future, and I thought I'd share some ideas that can help build the foundation for long-term success. Consider opening a savings account together. Make saving a tangible concept by opening a joint savings account and setting small goals. Involve them in budgeting. discuss household expenses in an age-appropriate way, and allow them to participate in making budget decisions. Lead by example. Demonstrate healthy financial habits like responsible spending and bill paying. Talk openly about your financial goals. Encourage earning money, whether through chores, allowances, or a part-time job, teaches valuable lessons about work and responsible spending. Start conversations early. The earlier you discuss money with your children, the more comfortable they may manage money as adults. Building a strong and solid foundation starts at home. If you're looking for more resources or insights, feel free to send me a message or reach out to us at Northbound Wealth Management at 317-399-1107. Hey everyone, in 2023, the number of 401k millionaires grew by 11.5%. Want to join the ranks of 401k millionaires? Avoid these common pitfalls, guys. Not contributing enough. In 2024, the annual 401k contribution limit is $23,000, $30,500 if you're 50 plus, because you get a catch-up contribution. Review how much you can contribute each year and consider making changes if possible. All right, tapping into your 401k prematurely. Don't do that. Borrowing from your 401k might disrupt your investment strategy. Taking money out of your 401k should be just one option to consider if you are preparing to make a purchase. Okay, and this third one is overspending and living beyond your means. Don't do that, obviously. By reviewing your expenses and creating a budget, you may be able to prioritize retirement savings. Here are 3 secrets to becoming a 401k millionaire. Number 1, commit to a contribution strategy and stick with it. Number 2, choose investments that align with your risk tolerance and goals. And number 3, set long-term goals and periodically monitor your progress. Remember, once you turn 73, you must take required minimum distributions from your 401k. Withdrawals are taxed as ordinary income and may be subject to 10% federal income tax penalty if taken before the age of 59 and a half. And remember, slow and steady wins the race. By staying committed to your long-term goals, you just might be able to join the growing number of 401k millionaires. One thing that I did not mention in this is make sure that if you are saving to a 401k, that you save enough to get the employer match. If they're matching, make sure you know that number and make sure you at least do that, because that's free money put into your account basically by your employer just by making contributions and participating in their plan. All right. Hashtag retirement strategy, right? Hashtag 401k millionaire, and avoid those financial mistakes. Make sure that you are a 401k millionaire, and stay tuned for the next segment. You won't want to miss that, because I'm going to talk about a nice article that will help support this view. All right. In your 30s and have nothing saved for retirement, here's how you could still retire a millionaire. This article was published by CNBC on April 9th, 2024 by Cheyenne Devon, and I really like this article and thus why I'm sharing it. I know this to be true because I run the numbers on savings rates, return rates, and seeing how much money people are going to have given those couple of factors, and time value of money and compounded interest, and it ends up being a lot of money later, whether it's 20, 30, or 40 years out. So here you go. Here's the article. If you're in your 30s and you don't have much saved for retirement, so those of you in your 30s, okay, and if you're in your 40s, cool. 50s, cool. 60s, it's too late. Just kidding. Just kidding. If you're in your 30s and you don't have much saved for retirement, you're not alone. As of the fourth quarter of 2023, the median 401k balance for account holders in their 30s was around $20,400, according to data from Fidelity Investments, the nation's largest 401k provider. That's a far cry from the 1.46 million the average American thinks that they'll need to save in order to retire comfortably, according to Northwestern Mutual's 2024 Planning and Progress Study. But don't panic. Even if you have little to no retirement savings, you can still get back on track and even retire as a millionaire. You just may need to set aside a bit more money each month than if you had started earlier. CNBC calculated how much you could retire with if you contributed $1,000 a month to a retirement investment account starting at the ages of 25, 30, and 35. These calculations assume a starting balance of 0 and an annual rate of return of 6% or 8% until age 65. Additionally, the calculations don't account for unpredictable events like market volatility. If you start at age 25 earning a 6% annual rate of return, you'll have $2,001,448. Earning an 8% annual rate of return, you'll have $3,514,000 in change. If you start at age 30 earning a 6% annual rate of return, you'll have $1.431 million. Earning an 8% annual rate of return, you'll have $2.306 million, okay? If you start at age 35, so 5 more years later, okay, age 35, earning 6% annual rate of return, you'll have a little over $1 million, $1,009,000, right? Earning an 8% annual rate of return, you'll have $1.5 million and some change. As you can see in these calculations, the sooner you can start saving for retirement, the better. That's because you give your contributions a longer amount of time to grow through the power of compounded interest. But try not to focus solely on your account balance at any given time, since it can be impacted by factors beyond your control, such as market volatility, so the fluctuations up and down of the market. Instead, financial experts typically recommend focusing on your savings rate. How much are you actually saving, which is the percentage of your annual income that you're contributing towards your retirement accounts, such as a 401k. Fidelity recommends aiming for a savings rate of 15%. Northbound Wealth Management, I typically agree. Try to save about 15% of what you're making, including any matching contributions. So did you hear that? Including matching contributions. A lot of employers will match 4% of what you're contributing, 5 or 6 or something like that. And remember, it is okay to start small and work your way up. You've got plenty of time. You're just going to have to end up in a slightly more aggressive savings rate than you would have been if you started earlier. So the later you wait, the more you just need to save earlier. And that makes sense, right? That's common sense. And that's fine. Ann Lester, a retirement expert and author of Your Best Financial Life, Save Smart Now for the Future That You Want, told CNBC in March. I happen to agree with Ann Lester. Great job. So, yeah, that's why the IRS sets up catch-up contributions. So if you're over the age of 50 and a half and you don't have enough saved for retirement because you've been maybe spending that money on your kids' college education or whatnot, they allow you to put additional money in so that you can get to the point that you need to reach your goals, for example, in your retirement accounts. Okay, so yeah, very important to start early. Those of you in your 20s and 30s, really start early, establish that discipline early and budget discipline early so that you can have money later in retirement. And retirement, by the way, from my philosophy and Northbound Wealth's philosophy, is doing what you want to do, not what you have to do, and having the financial freedom to choose. So hopefully you find something that you love to do and you do that and you end up making money at it. Then it's not work, right? And you get to save and do everything that you want to do in this life. For the most part, obviously, there's a bunch of things that can happen in life. So anyway, I hope you found this article helpful, informative. Have a great rest of your week and weekend, and we'll talk to you next week on the Northbound Wealth Podcast. Follow us, like, and subscribe. Talk to you soon. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.